Fresh inflation data is in focus this week after a surprisingly strong job report in the US triggered speculation that the Federal Reserve could be a lot more aggressive than expected. Friday's report of 467,000 jobs added in January confounded Wall Street economists, some of whom expected a negative number due to the impact of the Omicron COVID-19 variant on the workforce. Payrolls were also revised higher in November and December, and wages grew 5.7% year-on-year pace in January. The Consumer Price Index will be reported on Thursday, with a headline number expected to stand at 7.2%, the highest figure since 1982. This, according to analysts, is set to fuel further market volatility after a rollercoaster week for Wall Street. For more on this now, let's go to Han Tan, who is Chief Market Analyst at Xinity Group. Han, many thanks for being with us today. So we've seen this week a very more hawkish BOE and ECB, also a strong US jobs report, and obviously we're waiting for a key US CPI release this week. I mean, yields have been moving higher. How nervous are you that we may get to a serious repricing in the bond market?
Well, I wouldn't use the word nervous, but it's certainly something that myself and many market watchers are paying close attention to. I think ultimately that next bout of volatility could come by way of some economic data or even commentary out of Fed officials talking about their intentions for not just the path for rate hikes, but also the expected balance sheet runoff, right? So I think the key indicator will be not just the nominal value of, say, 10-year US Treasury yields, but the pace at which it spikes higher, with that 2% mark being the psychologically important level. So I think that catalyst could be commentary or data, and then I'm sure there could be some major repricing that's still left to be done across asset classes.
Interesting, Hannah. My question on inflation, we said inflation is the main worry this week, and not only this week for investors. I mean, rising rates cannot solve other issues such as supply chain bottlenecks and high energy prices. I mean, are we heading towards a potentially stagflationary world where rising rates is going to depress growth and not really sort out inflation?
So there is that risk, and markets are cognizant of that, and I'll get to that in a bit. But to address the first part of your question there, yeah, you're right. While it may not address some of these supply disruptions, but at least it offers the demand side of the equation, a chance to perhaps find a better equilibrium that's perhaps more palatable for consumer prices, right? So I think that's the traditional narrative there. But you're right to point out that the risk of a policy mistake by not just the Fed, but other central banks, I think that's weighing on market minds. If you look at the spread between 2 and 10-year yields, it's fallen about 20 basis points so far this year. That puts it about its flattest since, I believe, the final quarter of 2020 or so. All right, so that shows that markets are wary of the scenario that you highlighted earlier by way of a policy mistake by one of these major central banks.
Han Tan, thanks for being with us this morning.